Quick question. What if waiting until you're 60 to buy long-term care insurance meant that you never qualify at all?
Yeah, most people don't realize this, Jonah. By the time you are 60, a single diagnosis like diabetes or high blood pressure can either double your premiums or completely shut the door. Of course, insurance is something you need to have before you need it.
Right. So welcome back to the Banking Bros podcast, where we help you take control of your money and your future.
We're talking a piece of advice you've probably heard, not heard. I don't know. You guys let us know. Even from big financial voices out there like Dave Ramsey, we're going to wait around to get long-term care insurance till 60.
Yeah, the problem with that, in my opinion here, is that advice can cost you big time. It can cost you in money, obviously, right? Even in the event of life insurance, people know the longer you wait, the cost of insurance is a little greater.
Yes.
So that's absolutely going to play into a part of long-term care. It can cost you options. You might not have very much time. People might already be sick. Sometimes your ability to protect your family at all is compromised, because what if you just don't qualify anymore? So we're going to break down why waiting is so risky and how you can actually just plan smarter now, and why asset-based long-term care is quickly becoming a really smart way to secure your future.
Remember, ladies and gents, here at the Banking Bros podcast, we are always available as coaches to have a convo with you, code-cracking conversations about your cash flow. That's what it's all about. So, Jonah, number one, let's get into what is what. Yeah. A lot of people maybe at our age especially, may not be familiar with what we're talking about. We don't want to lose them, so tell them what is long-term care insurance and what is the new kind, the kind we like to chat about, asset-based long-term care.
Sure. So let's jump in first. What in the world is long-term care insurance? I actually did not know this until recently.
Yeah.
No idea what it was. So if that's you out there, listen up closely. Long-term care insurance is an insurance policy that you can purchase that is going to pay the money, right? Insurance, pay the money in the event that you need long-term care. Now, what in the world is long-term care? Long-term care can be in-home care, nursing home care, assisted living facility care. So you've got to think, if you've ever gotten some sort of like physical ailment, or you know an older person in your family or friends that's got a physical ailment, they can't do all the stuff they need to do, they need long-term care. They need someone to come help them. You've got to think about if people get cognitive disabilities like dementia or something, they need help, right? You have to pay someone to help. And the long-term care kind of trigger is that you cannot do 2 of the 6 activities of daily living. And these activities are...
I'll list them off. I got them right here.
Okay, yeah.
I'm ready. So it is... Oh, do I have them?
I got them.
Okay, transferring.
Yep. Which is like getting up and out of bed or back into bed.
It's the stuff that you'd have to do for a baby, by the way. This is what long-term care is. Okay, so it's when the adults of your life turn back into babies because of a cognitive or mostly physical impairments.
Yep.
Transferring, toileting.
Yep.
Feeding themselves.
Yep. Bathing.
Yep. Showering, bathing.
That's 4. We need 2 more.
I'm losing it.
I think that while you look up the other 2, I think that when you start hearing about this, it kind of makes more sense, right? You get people in your mind, in your mind's eye, people that are older than you in your family or whatever, friends, and you start to realize, oh yeah, some of these folks totally need help in these areas. I know some older folks who just can't transfer very well at all. They cannot get up and down stairs, up and down out of the bed, up and down in the car, right? Stuff like that. And so you realize, oh, yeah, I totally understand that. And when you cannot do that and you want help or need help, that's long-term care. You need care that's not going away, right? That's the long-term attribute of it. So the craziest part about long-term care, in my opinion, is actually the cost associated with these services.
Right.
I did not know.
Oh, I knew. We've talked about this once or twice before, because 20 years ago, I worked in an old folks home. When I say old folks home, I mean that respectfully, an assisted living facility. And there's lots of people out here who are now physically still with us. They're mentally maybe slowing down. They're physically slowing down, but of course they're not dying. Modern medicine and many different crutches, physical crutches, wheelchairs and canes and walkers are helping people at least stay with us for longer. So here we go, the 6 activities of daily living. I found them: bathing, dressing, toileting, transferring, eating, and continence.
That's the one.
Got to be able to keep it in. Yeah, because you think toileting is
you just don't realize that they're different.
Right.
And plus, I don't say continence. That's not a word that's in my vocabulary.
Right.
Regardless,
incontinence.
look at how much these cost. So we actually went to the Genworth's cost of care survey.
Okay.
And actually, we've got some pretty cool options for those who are interested in learning more about long-term care, which we'll let you know a little bit later on in the episode. But specifically, the 3 that we talk about that are most common: nursing home, assisted living facility, or sending someone to the house, because people don't want to leave the house, right? Look at the costs on this. So the least expensive one is an assisted living facility, right? Because I think...
Now these are national averages across the board, ladies and gents. We live in a place where
obviously
it might
that means
be
it's a little bit
higher or lower.
It's a little bit higher in New York and California and Texas. People know that, right?
Right.
It's a little bit lower if you live in Oklahoma or Kansas, right?
There
That's how national averages work.
Everybody knows this.
Right. But assisted living facilities, now correct me if I get it wrong, assisted living facility is you don't have someone 24/7. They assist you with at certain times with certain things.
Yeah, it can be all sorts of things. At the folks' home that I worked at, there was always a nurse practitioner on duty, 24 hours, but there was, at this very small facility, 55 or so beds, there was one of those people on duty.
Okay.
You see what I'm saying? So it's not like everyone has an individual nurse. So, what we've got here is during the day, we've got orderlies, you might call it. I'm not sure. I was working the front desk, by the way. I wasn't administering pills. So we've got people in here who are working and making the meals for everybody and stuff like that. But there was always a nurse practitioner on call. And what they help you do in a assisted living facility is help you remember to take your medicine. Right? Stuff like that. Jay Do, working the front desk, would walk around and push people who didn't want to push themselves or be in their seat and then just use their feet. You know what I'm saying? To get to, assisted living, we'll help you do that stuff. Or, hey, you drop something, hit the call bell. Jay Do comes by. Hey, Jay Do, I dropped my remote.
And they can't get it.
So I was like, I'll get it for you. The assisted living.
So those are the least expensive on our list. The average in the United States of America this last year is about $70,000.
Ladies and gentlemen, are you listening? $70,000 is above the average income for a family in U.S.
It sure is. So again, think of this scenario, right? Maybe you're married, you've got kids are grown. Maybe it's mom or dad who now needs to rely on you. They cannot do the things that they used to do. You've tried to maybe move them into the mother-in-law suite. It wasn't working. You moved them down from wherever they lived and now they're with you. You've got to put them in assisted living. That's the only way you're going to make it. Oh, and by the way, here's a $70,000 a year bill for this. And let's call it, they're 60, 65. You might have that bill for another 10,
I do remember
years.
Being surprised at how very few people in the facility, and it was a small facility, like I said, 55 or so beds. Some people were not that old. They were not that old. Now, there was one dude in there whose son would come by on the weekends and hang out with him all the time. We had Mr. Kenneth Sr., Mr. Kenneth Jr. Mr. Kenneth Jr., who came by, chatted with me all the time. He was 80. His dad was 102.
That's old.
But there were people younger than Mr. Kenneth Jr., who was 80, who were in the home. Because it was just easier. Like you said, it was their familial situation was not good enough for them to live there. They had needs their family couldn't handle. They had a size or a weight differential. That's a big deal because if you're transferring people, we got to be able to move them.
Too big, or, right? Or you're not big enough, right? You're just single lady.
I'm smaller, and grandma's big, or grandpa's big.
Mom or dad.
Dead weight is a thing when it comes to this type of. So it was very interesting that some people were younger, you would think, and they were. And heck, I remember Mr. Kenneth, if he's still out there, still living, I guess he's about 100 now. He'd be like, the problem I have, are you ready for this? He used to tell me, he's like, he was very much there. Big guy, too. He was big. His dad was skinny and small, but he was 102 years old. And he would say, problem I got now is I got to worry about my dad outliving me. I'm 80.
That's true. That's crazy. Anyway, let's go on to step 2, the home
Okay.
health aid, because I know a lot of you are thinking that. I got parents who are like stuck in their ways. They are not leaving the house.
Yeah,
right?
yeah. Which is,
But you can't leave them over there by themselves if they cannot do some of these things. Can't go to the bathroom, can't keep it in, can't get in and out of bed. You
Can't dress themselves?
Yeah,
Yeah.
you can't leave them over there, right?
Right.
So you got to have a home health aid because they won't leave. Well, that'll run you about $77,000 per year.
yeah. So these are the national averages from this survey. Once again, Genworth's 2024 cost of care survey, but $77,000. We've just went up because now you've got a private on-call, maybe a live-in person, right? They can live at the house with them, and they need to get paid.
That's
and
right.
I want them to be. I mean, let's assume this is
We need
our
to pay
family.
them well so that way
Yeah.
they treat the people well. You don't want to underpay them. They hate being there and they want to quit every 3 days. You got to get new people. You don't need that.
That would be terrible.
Right? 77. And what about a private nursing home?
This one is the one that'll get you.
2024 cost of care survey says that's about $127,000 a year
Jonah, that's going
for
to
a
be,
private nursing home room.
that is above 10 grand per month.
That sure is.
So the question out there, ladies and gentlemen, if you're watching us on YouTube or you're following along on our TikToks, our podcasts, our Facebook, how many people do you know, or is it you, that do have the ability to stroke a check or liquidate assets that are going to pay 10 grand per month?
Right. Because of the costs, because of the length of time. We didn't even really talk about that,
No,
but
we didn't
length
get
of
there yet.
time.
But we went too far forward before we went back.
Well, I was just kind of walking them through what it is and how much this stuff costs.
So what it is, once again, traditional long-term care insurance, ladies and gentlemen, is a long-term care insurance that is a use it or lose it feature. So if you don't need it, I mean, maybe you die in your sleep at 59, which is what I decided I was going to do when I was 21 years old and I worked in the old folks
I'm not
home.
sure you get to decide, man.
Yeah, well, I consciously put it out there. I don't want to move in here. And it was a place that I worked at, meaning that I was part of the caregiving. I was part of the family-friendly atmosphere. J-Do, if you know anything about me, I ran the games and called the bingo and turned on the popcorn on the weekend. Like, that's what I'm doing, and push people around to lunch and dinner, sit and chat with them. I mean, there's a lot of people in there who you could talk to, but, like, it's not their family.
Yeah.
So anyway, people get lonely. And I got to meet their family, the ones who came by, Mr. Kenneth Jr. So what's interesting about long-term care insurance traditionally, just in case you didn't realize, is that about 20 years ago it started to shift or so, but it was a use it or lose it thing. So in the event that you did not cross the threshold into long-term care, some of you who have disability
which can be
insurance,
tough because you can have one of those things you can't do very well,
Right.
but not two, and then they don't give it to you.
So we're talking about a licensed professional saying you cannot perform two of these functions, or you have severe cognitive issues like Alzheimer's, something like that. Okay. So what happens is after 90 days, long-term care kicks in, right?
Yep.
Most of us know that. That's 90 days of emergency fund. That's a whole nother topic, Jonah. 90 days of emergency fund because
gotta
you're
pay
stroking
for it.
checks
Yep.
at that point, right? So let's say there's an injury or an accident. You're stroking checks the first 3 months. After that, prolonged issue, doctor prescribed or diagnosed long issue, you have no idea how long it might last. But if it never happens to you, you'd lose the insurance. There was nothing.
They don't give it to you, right?
Okay, so now most people, we'll get into some numbers here in a second because we've got some facts and figures for you. Most people, most couples, by far, you'll be amazed at the numbers, will need long-term care for a period of time.
At least one of them. At least
least
one
one.
of them in the couple.
Okay,
Yep.
at least one of them. But asset-based long-term care, the stuff we like to talk about and try to line people up with, is going to be the kind that is not use it or lose it,
Yeah,
Jonah.
it's big.
What's going on here is there will be a death benefit
It
in the event you didn't need it.
It combines like your long-term care coverage with life insurance.
Yeah.
And so that's why we're talking about it on this podcast, because we were not aware that this was a problem, that we should pay attention to this insurance, that we should have it. But of course, we were introduced to it when we help people with the infinite banking concept. We do that through whole life insurance,
Which is a guaranteed product. We want
guaranteed
guarantees.
product. That's what's
Yeah.
important to us. And then we were introduced to, did you know long-term care is built inside of life insurance also if you get asset-based long-term care insurance? And that's what we're
Guaranteed product.
talking
so
about
it's
here.
going to pay out. So it doesn't work exactly the same way in terms of the death benefit, being as big, okay? So it's meant to kick off your care needs on a monthly basis for the duration of your care. We highly suggest when we're coaching people that you plan for the style, in most cases, that would pay forever.
Yep.
So the trick is, are you willing to take on the risk with your income, with the care that you need, and with your assets to kick off the money if you need it for a long time? There were some people who lived in the facility. I just know the facility. I mean, the grandma-in-law, as well as who's still in care, and also the place that I worked at. There were some people who they were there for a long time. Long time, because you could tell it was basically a transferring issue, and it was a dressing issue. Like, these people are going to live here for 15 years.
Yep.
They're totally fine.
But they can't transfer well,
but
they hurt their leg, they're in a wheelchair, and so it's very hard for them to get dressed.
So they would qualify for this, but they're going to live for, they're 75 years old. This lady's going to live here for 15 years.
Yep.
So if you want to take on that risk with your own assets, then go for it. But asset-based long-term care, in the event that you don't need to use the benefit, it will pay out a death benefit to your beneficiaries. Yep. So those are the two differences. So we're talking about asset-based long-term care. That's what we mean. The kind with the guarantees on it, even if you didn't use it. Now, in the event that you use lots and lots and lots and lots of monthly checks over and over and over to pay for your care, it drains the death benefit. There would no longer be a death benefit because you took way more money than the death benefit would have paid. But I think everybody understands, well, that's the point of the insurance.
Yep, that's the point of the insurance. Cool. So here's where it gets fun for this episode today. We went and found a clip of a very famous person out there. He used to be just a radio personality, in my opinion. He's now moved to all socials. He's written a bunch of books. He gives lots of financial advice. That some of it we agree with, and some of it we do not. In this particular clip that we found about long-term care insurance, he says about maybe 10 things that we just do not agree with.
All right, we'll count them up as we listen.
And we are going to play that clip for you. We want you to pay attention to the common vernacular, the common advice out there, and we're going to talk about how we differ from it and why. So if you are listening to us, you'll be able to hear this clip from the beginning, and if you're watching with us over on YouTube, you'll be able to hear and listen. Here we go.
David is in Montgomery, Alabama. Hi, David. Welcome to the Ramsey Show.
Good afternoon, gentlemen. How are you guys doing today?
Better than we deserve. What's up?
Fantastic. So I'm looking into long-term care insurance for my wife. She's 55. Actually, we're both 55. So we probably need to wait another 5 years, as you usually recommend 60.
Yes,
but
sir.
Understanding that, my question is, when do I consider her self-insured? As I think we're kind of on the cut line for considering ourselves self-insured or needing long-term care.
Yeah. Well, self-insured always means you can take the hit for the expense without disrupting the whole plan.
Okay, Jonah, I'm going to jump back in right here already. Now, we started out this episode chatting about the age.
Yep.
60. This guy calls in. He's 55 years old.
That's
he and his wife are very similar age, I suppose, unless I missed it. And Dave says you wouldn't even jump in and start buying it till 60. How do you feel about that?
I feel like that's our first one right there.
Okay.
That's incorrect. I think, man, it's like, in my opinion, it might not be common knowledge for you, but it's pretty common knowledge when you, well, first off, insurance, period. You must buy insurance before you need it. That's standard. Everybody knows that. You don't qualify for car insurance if you've already got in the car. If it's your car is actively totaled, you're not getting the car insurance.
Yes.
You have to buy it before you need it.
Okay.
So when we're talking about health care and costs and possible I can't do stuff, you have to buy it before you need it. This guy says, my wife's 55. I want to buy it for my wife. I'll wait till she's 60. That does not seem correct to me.
Now, here's my question
Gotta buy it
here,
before you
because
need it.
obviously we have very similar thoughts. But do you feel that you are putting doomsday into people's mind by saying,
No,
Don't wait to 55.
No,
I mean, don't wait to 60.
No, I buy lots of insurance. I once you kind of understand the ins and outs of insurance, I have opted into a significant amount of insurances just because you have to get it before you need it. So like I used to book flights and not touch the travel insurance.
Sure.
Like
right.
I'm just going to scroll on right by that.
Good example.
I have
Good example.
insurance on almost every flight that I take now. Now, again, you can go about it a couple different ways. You can click the little bubble on the website and buy it for $20, right? Or you could book flights through your credit card and they give you the insurance. But I've got insurance on all the flights. You know why? Because there have been a few where they've lost my bag or delayed it too long. I couldn't make it. But I've got insurance, so I can get the money back or I can get compensated or whatever. That's what insurance does. If you do not have it and that stuff happens to you,
you pay for it.
Yeah, you pay for it.
You eat it.
You eat
which is, Dave Ramsey's going to talk about that in a second. But the second thing that I want to jump in here and chat about is the fact that many people are starting to get diagnosed, especially with cognitive issues.
Oh, a lot earlier than
60.
Yeah.
So if you get a cancer diagnosis, that's going to qualify you potentially for an ADL situation, right?
Yep.
2 ADL situation. If you have, God forbid, you have just a cognitive issue like you have early onset dementias, that's happening way earlier for people. I guess they're putting stuff in our food. I don't know. This isn't a conspiracy theory type podcast show, but maybe we need an episode. So people are getting hit with this stuff earlier. And the insurance company understands, well, now you are past the point of the risk.
You've already got one. You've already got ADOs. We can't insure you for that. You already got them.
So how many of you out there know somebody in your life that has needed care? Maybe it was you, even if it was a temporary amount of time, but you are not 60 and you needed care. Just last night, I was leading a live coaching call with one of our weekly calls, and somebody who's an infinite banking client of ours mentioned, my mother needed 18 months of cancer care at 48 years old.
At 48. Can't wait till 60.
Okay,
for
keep going.
Insurance. Let's keep listening to what he's got to say.
Okay, so let's kind of walk that through. The average nursing home stay in America is 2.5 years. Typically, the typical scenario is 75% of the ladies outlive their husbands. And so the typical scenario is Papa goes into the nursing home, burns through $300,000, and if that was the entire nest egg, he cracks and scrambles the nest egg, and scrambled eggs, and dies and leaves Mama with nothing. Okay? So we obviously don't want that. So if your entire net worth is $300,000, you can't do that. You have to have good long-term care insurance. If your entire net worth is $10 million, you can write a $300,000 check and not blink. So if the average nursing home stay is 2.5 years and the average cost is around $100,000 a year, then that's $250,000 to $300,000 is your typical exposure. Could it be more? Yeah, it could be, but it probably won't be. And you could do in-home care even cheaper than that and maybe get better quality care depending on the type of issue that you're dealing with in terms of caring for the individual. So,
okay. All right.
You had to do it.
Okay. Which parts do you think are the most egregious?
One of the most egregious parts, I've talked about this before, it's his philosophy that you should self-insure. It's his philosophy that, well, if you've got the money, just pay for the whole thing. It doesn't make any sense to me. If I've got $10 million, it's because I worked really hard for $10 million. It's because I saved well. I saved properly. It's because I invested well. I speculated well. It's because we worked really hard to get $10 million. You don't fall into $10 million, right?
Sure.
So the people who have it worked hard for it. The people who have $10 million at no point are going to say, oh, I know that possibly there could be costs that come up around healthcare for $500,000, but don't worry, I'll just write a check. People with $10 million don't make decisions like that. People with $10 million buy insurance for $1,000, so they don't ever have to write the $500,000 check. That's how they got $10 million, not just by saying, oh, finally, I made it to $10,000. If the fridge breaks, we'll just buy the $2,000 fridge. Who cares? Let's not sign up for the warranty. Oh, I finally made it to $100,000. If the car breaks down, we'll just buy the new $50,000 truck. We won't get car insurance. Oh, when I make it to $1 million, if my house burns down, I'll just buy a new house for $300,000. We won't get homeowners insurance. Those are not the decisions you make. It's bad thinking. It sounds great when you say it on a radio show. in reality,
It actually does.
It is terrible decision
Okay,
making.
so here's what I want to say. I'm going to pick on something else, and it's for your consideration, and it's the length of stay. It's the length needed of care.
Okay.
I agree. The average numbers are on the money, 2.5 years.
Yep.
Now, that is per person.
Yep.
So in the event, which he gets to later on in this discussion, Papa burns through it, right? Papa goes first. Mom is normally healthier. Grandma's healthier, that type of thing. He's going to burn through maybe $300,000.
That's what he said.
Now, here's the challenge. The challenge is, what if it's longer than that? And what if some of the care started to be needed before you qualified?
Before the 90-day window.
Not before the 90-day window.
Okay.
You
before
did not
qualify.
Before you qualify,
you got one ADL.
You got one ADL.
Got it. So
that never shows up in any survey. So I have a question for you, Jonah, and everyone else out there. Do you sometimes have some sort of issue like transferring for years, and grandma's trying to drag grandpa around the house before he'd qualify?
Yep.
That's a big deal, okay? So we've also got to consider, which we haven't got to yet, is what happens when other people in your family need to be a part of it.
Mm-hmm.
Can everyone continue working if grandpa needs some help?
Right. You're going to leave him in the chair for 8 hours a day while
That's
you
a
go
big
to
deal.
work?
That's a big deal. So if we end up moving inside a facility, and what happens if we end up with a cognitive disability, and that cognitive disability qualifies us for care, and it's 20 years.
Yep.
So according to Dave's, you probably won't need it, but I have a question.
Said.
Don't many of you out there, including myself, know plenty of families who have something and someone going on that needs way longer than 2.5 years of care.
Way longer.
Way longer. So average is average. I get it. That's totally fine. But what happens before you qualify, and the stress and the pain on your family, the dignity you might have to succumb to undignified ways of getting things done because you're not really qualifying yet for the care. And 2, what if the care is longer? Now, most people don't need longer care. That's what average means, right? Somewhere in there, there's an average line. But if you are the person or the family that needs longer care, it's no longer average. It's you, 100%.
Yep.
So how are you going to pay for it?
Right.
Big deal, I think. So I think some folks need to realize that if they're living a long time, they're having health concerns or lack thereof, or they think 2 people might need that care, you're going to burn through the money. Also, I have a speculation that Dave Ramsey does not talk in terms of asset-based, meaning it's probably use it or lose it in his mind, which has been the typical
thing, right?
Yeah.
I think the U.S. Department of Health and Human Services says that over 70% of Americans over 65 are going to need some type of long-term
Those are the
care.
numbers.
And it's
Okay.
That's high. And it says half of those people are going to need it longer than 2 years. And it says 1 in 5 of those people are going to need it longer than 5 years or more.
Yeah,
right?
and I think it's only with the aging population of the baby boomers just now hitting the needs.
Yep.
Just now hitting the needs of long-term care insurance and care, home health. You realize that if you have a problem, you can't eat, feed yourself, and you cannot transfer, you can have someone come to your house and be paid for with this type of insurance.
Yep.
So now you have a chef come by.
Yep.
And you can have the insurance pay for it.
That's right.
My life just got better.
Right.
You know what I'm saying?
So
and I want that to happen for a long time.
So a few things I think you just got to
Right.
pay attention to,
Yeah.
right? When we're talking about this type of insurance, this type of care, we're saying a few things. One, it is super expensive. I don't know about you, but there is no way in the world that right now, my financial state right now, that I should plan for an $80,000 bill for 10 years to help take care of mom when she needs it. She's a lot older than I am.
Jonah, you just brought up another huge idea.
I cannot do it.
If your elders in your family or someone like your spouse need care and they don't have the insurance, who's going to have to pay for it?
Right.
Who's going to go over to the house and help? Who's going to have to stop working? Who's going to pick up your dead weight, half-dressed mother and put her in the tub?
Right.
Hopefully someone you know, right? If you're able to do that. Most children and grandchildren are interested in the care of their elders, but now you can't go to work.
Right.
You're stuck at their house.
I've seen some statistics that say, like, if you're the primary caregiver, the family member, the primary caregiver, no insurance, you're doing it out of the love for that person, the love in your heart. I've seen some reports, some statistics say that actually you, the person providing for them, lose their job, get stressed out, pass away before the older person. It's too stressful.
Mr. Kenneth Sr., now I got to worry about me dying before Dad.
I've seen some
He's
crazy
comfortable.
statistics. So for me, it's
Right.
like, hey, plan early, right? Like we read some books, right? Begin with the end in mind, and all these kind of phrases that you've heard us say before, you've heard in the general population, the general public, you've read them, you've seen them online, whatever, the memes. It's plan before you need it, everybody. Plan ahead of time. And I get it. You're going, whoo, budget's tight and all this stuff, but I'm going, budget's way more tight if you don't plan.
Ladies and gentlemen,
Right?
also think about this. You're going to have to, if you end up not buying in time, if you wait till 60 years old and now the premiums are higher,
Yeah.
the population is aging, the demand is going up, the price goes up.
We haven't even talked about like inflation. What is
Well,
it
yeah,
actually going to be 30
Correct.
years from
Okay,
now?
that's what I'm saying. There's so many ways we could go about this, but we started talking about the age.
Yep.
Okay, 60 years old. So if you wait to 60, when a person like myself might be able to, number one, I know that I qualify. I qualify to get the insurance.
Mm-hmm.
So I can buy it right now. I can pay for it, maybe have a 20 pay, right?
I mean, you pay for 20 years.
I pay for 20
And I've
years, so
done
I'd be
it.
61.
Yep.
I'm done paying for it, but the benefit is there forever
Yep.
if needed. The death benefit will come to my
Just in
family.
case I don't get
But I
sick.
bought it when it was the lowest amount of cost,
Yep.
right? Here's another thing. You pick the benefit amount. Some
Mhm.
people probably haven't visualized that. So let's say you want the benefit to be $5,000 a month. So you figure out in your budget what you can pay because $5,000 a month is what you want. That does not mean every healthcare cost would be covered. $5,000 a month is your benefit. It will cap
Yep.
every month. However,
That's
what-
$60,000 a
that's
year.
$60,000
Maybe
you don't
you've
have
only
to
got to
come
come out of pocket with 15 or 20.
Right.
a
And
year.
most of the
That's
time,
way
those,
better.
we'll help quote you with this type of stuff when you call us, but
Yeah.
that's going to be less than probably for a person my age, it's going to be less than $4,000 a year.
Yep. We've even had some unique strategy when talking about this with some other folks, and they said, here's what you actually should do. You should buy a policy in your 30s or 40s for maybe $2,000 a month of coverage. Then in your late 30s,
Yeah,
early
5 years
40s,
later, buy another
get
one.
Another $2,000. Now you got a total of 4. Then you get older, you get another $2,000 a month, and so you stack them like
Yeah.
this. If you can't afford the whole thing right now, you stack them, and then all of a sudden you've got 4 policies. 5 policies. The total is $12,000 a month. That'll cover all of the costs, but you paid for them intermittently. You paid for them when you had the money. You paid for
When you qualify.
When you qualify,
You pay them. So if I buy it now and the cost is X, 5 years from now, the cost will be X plus 1.
Yep.
But I've already qualified and bought some of it.
Yep.
I've bought away that risk and transferred it to the insurance company.
And I thought that was a pretty good strategy.
Oh,
I
yeah.
hadn't heard that. I hadn't thought about it before.
Yeah.
But as
Plus,
you
of
talk
course-
to people that can help you, you can think through all that stuff.
Plus, of course, we teach people the infinite banking concept, and in the save and spend system, you're going to end up with a system of banking policies, whole life insurance that you can leverage from. Well, what should you leverage for when you borrow cash value? I'm going to pay for my long-term care policy with these dollars that I'm borrowing against my whole life insurance.
And if you're listening out there and you're going, well, man, the premiums are just tough, there is actually an option at one of our favorite carriers where you can use qualified money, government-sponsored money. You can take money out of like your individual retirement account, your IRA, to cover the cost of long-term care insurance without having to take the tax penalty.
Let's go.
So if that's you and you've got money in a plan or program like an IRA like that, and you're going, what? I can use that money to pay for this insurance? And I don't have to worry about taxes? Yes, the answer is yes. And what you should do is reach out to us by selecting the link in our bio, selecting the link in the description, selecting the link on our YouTube channel, wherever you are, and reach out to us and let us know that you're interested in having that conversation. We'll walk you through it because it is too expensive. Because of the health risks that we face in this country and the things that are happening, it is too common to ignore. Do not do that. You're going to put yourself in terrible straits and situations if you can, right? I don't know about you, but maybe the cost 10 years from now, 20 years from now it was at 70,000, 80,000 now. Maybe it's up over 100,000, 150,000. And if you have a nest egg or your cash flows, right, aren't super big when you get to retirement, but they are healthy, maybe $500,000, $1 million, you're eating through that, because this is an additional cost on top of however much college is going to cost for the kids and however much the housing market, like this is extra. And you're probably losing someone who can help benefit. You're losing income because this person just can't do it anymore.
It's a big deal, ladies and gentlemen. Even our government is concerned, very concerned with this. And I think you should be on an individual level. And you should have a code-cracking cash flow conversation with one of us soon. It's now time for our fan follow and shout out of the week with this podcast episode. We'd like to say hey to Creative Capital Group on YouTube. What's up? Hey, glad you're here. And our YouTube channel is called The Banking Bros. And folks who join us there get the long-form content we produce every single week that helps them understand how they can save their money and spend someone else's. We hope we're going to chat with you, Creative Capital, very, very soon.
So here's the takeaway. Rating. What did I say? Rating?
You did.
Waiting.
The rating is important here.
Rating is important. You got to be healthy. But waiting until 60 is not just risky. It's often actually the losing side of the equation. It's the losing bet. Yeah, you got to think about your health. You got to think about cost. You got to think about the odds, the percentages that something has already happened. All that stuff's going to work against you if you wait. So by starting now, maybe by stacking policies, I'll buy one now, inexpensive. I'll buy another one in 2 years, a little bit more, right? Whatever. You can, using asset-based solutions, this is important. We don't want to use it or lose it situation. Nobody wants that. You can protect your family and your finances without wasting money.
So once you hit 35 years old, 35 plus, 40s and 50s, it's time to think and act. Don't wait until your health care costs too much or you no longer qualify to make it nearly impossible to do this strategy.
Yeah, so you can visit thebankingbros.com to schedule a conversation with us. You can click the link in the description of this video. You can click the link in the show notes, and we'll build a plan together that protects your future and protects the people that you care about most. Thanks for watching.
You are now tuned to the Banking Bros. Said we couldn't make it, drink or settle, this the life we chose. Gave a lot of game, we never got a lot of things. Bow your head and say the prayer, we taught you how to be the bank.
Dave says debt is dumb, but sometimes I think Dave might be dumb. Ladies and gentlemen, on this episode, we walked and talked through how waiting to buy long-term care insurance until you're 60 years old may not be the best strategy for you at all. We'd love to walk and talk through your family's scenario, but not just your family. What about the people that you know and might have to foot the bill for and care for in a long-term care situation? We'll talk very soon on a free cash coaching call.